Welcome to the Techno Fundamental Report for January the 15th. This is a great book. I read this book. I'm going to read it again, but it's very interesting. It's called How the Scots Invented the Modern World. And the bottom line was that there was a period of time back, centuries ago, where people from Scotland migrated to the United States of America, and then they linked up with other smart people and started inventing things like, Bethlehem steel and so forth. So it's an interesting book, would recommend it highly. And so I would like Americans to make things with their hands. Thomas Jefferson and I feel that makes for a much stronger nation. So that's all about what we're talking about here. We need to get back into making things. Once you've sold your soul to the devil, you can't then ask for it back. So don't sell your soul. And what I'm saying there is that when you look at a strategy, an investment strategy, hindsight is 20/20. That's history. So we look back on things and we go, hey, Bitcoin, I should be in Bitcoin or whatever because of the 20/20 hindsight. You could say the same thing that's going on with precious metals right now, but I remember the Beanie Baby bust. Okay, now this goes back to 1998. The most popular Beanie Babies sold for $1,300 on eBay. In 2018, they were down to $3. So it was kind of a craze that it became hot money. And I see the same thing all the time. Just be really aware of the fact that history is history. You're not going to be able to get into everything. You're going to have hits and you're going to have misses. But the main thing is to develop a strategy that is consistent, where you can be patient and you can use your tools and so forth. But I did want to mention one of the biggest concerns out there for me is competition. And when you start looking at companies that have a lot of competition, it means profit margins are not going to do well. It doesn't most of the time. So finding a company that has very little competition in this world today is very difficult. But I think it's one of the things to look for. Now, we all know about precious metals. Now, we're seeing the price of silver actually kind of becoming parabolic here. This is hot money. This is not normal. I mean, silver prices have been stuck, roughly around $30 an ounce for 25, 30 years. But there are industrial applications coming on here, which has to do with electrification. So, we're very aware of this. I mean, we're very aware, but like the old Beanie Babies, you just don't know. And so I would keep an eye on silver and gold and platinum and the rest of them. But realize, I specialize in growth stocks. And you can analyze growth stocks based on earnings, balance sheet, income statement, cash flow. With this stuff, there really is no way to analyze it. But the only reason I think this is getting hot is because it's going up, just like Bitcoin. Now, it could be some industrial reasons why this is happening, but we are very aware of it. Now, we're also aware of the fact that our aggression index is really kind of showing some troubling signs here. This is where we take growth stocks, which is the NASDAQ, and we compare it to consumer staples, which is defensive, ketchup, toilet paper, that kind of thing. So when the institutions are worried, and being that they can't go to cash, they'll start moving their portfolio into consumer staples. So when that happens, it can be somewhat of a warning. This indicator worked real well for us back in 2021 when growth stocks peaked under the Tesla rally. But you can see here it's breaking down. Now the rule is you want to see the ratio back above the moving averages and take the lower moving average. It wants to be above the lower moving average, and the lower moving average turns up. But as you can clearly see, that's not happening. So the purpose of the aggression index is to say, should we be aggressive right now? I don't think so. I think we need to kind of continue to have a hefty cash position and continue to monitor. But right now, Growth stocks are not really participating in the market and they're lagging, and that's just not a good sign. Now, if you look at the consumer staples, what's happening here, just as part of the ratio, I mean, it's actually somewhat of a parabolic move like silver. So is this a run to safety? Could be. So we just need to be aware of it. Then you look at the financial stocks. They're the first ones announcing earnings in earnings season here. Kind of a breakdown here. This is not a good sign. We want to see the banks and the financial sector to be very strong. But we're seeing somewhat of a breakdown here, just like we're seeing elsewhere. New lows, though, we're not getting a lot of new lows, which means that the sellers have pretty much dried up. But there's not a lot of hefty buying going on in growth stocks right now. Price of oil continues to be in a downtrend. Now realize with the price of oil, the most recent thing that has happened is it made a new low. And it's not making any kind of meaningful new high. So as far as I'm concerned, so if you check out the amount of oil out there that's on the market, there's an excess supply. So as a result, the price of oil continues to decline into a downtrend. Who knows? It might go to $30 a barrel. No way to predict that, but I am saying don't fight the uptrend. The uptrend is still the downtrend is still in place. Now, when it comes to interest rates, we're continuing to see a very steady picture here. We're looking at the yield on the 10-year Treasury note, and you can see here by the power index for the last 125 days, interest rates on the 10-year Treasury have dropped by over 7%. So interest rates are pretty much under control. We're not seeing a big problem there. In fact, it looks pretty good. Primary trend continues to be up. We keep an eye on that 200-day moving average. You can see what happened back here at the bottom of the market in April. We broke down, primary trend broke down. We went into a bear market. So we continue to be in a bull market. So things look positive there, mainly on a long-term basis. Mortgage rates, I thought that was worth noting because interest rates are, so steady. We're seeing mortgage rates starting to trend downward here, and this will help the young people trying to buy houses and the real estate market. NVIDIA, I want to take a minute and talk about NVIDIA. The stock's been having trouble. All the AI stocks have been having trouble, except for some special few. Now realize here with the artificial intelligence deal, the build out, we're going to have winners and we're going to have losers. And just like the dot-coms. I mean, with the dot-coms, if you go back and, use 2020 hindsight, there's really only two stocks you really wanted to be in, of which one was like Amazon and Google. But you can see here with NVIDIA is rolling over. It's somewhat rolling over here. Now, the old low on the last correction, which was basically somewhat of a bear market in semiconductors, you can see the old low here was down around 170. Now, if NVIDIA turns around and breaks out above 200, we're back to the races, and the AI trade is going to be on fire. However, if we break down below 170, which is this old low, it could really spell trouble not only for the AI trade, but the market as a whole. Microsoft, you can see this is another one. This is another AI stock. And you can see where it's broken down below the 200-day moving average. That chart just does not look good to me. So I would tell you to be cautious about the AI trade. However, if you look at something like Google, you're seeing a very positive trend here. So maybe Google is going to be the way it goes. So keep an eye on Google, keep an eye on Microsoft and so forth. But I would favor Google out of the entire group. The group itself, though, is looking iffy. I would keep an eye on NVIDIA. If it breaks 170, it could be a real issue. Anyway, thank you very much. Let me know if you have any questions. Thank you.